You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Sure, an argument can be made that the junior sector has sucked over the last couple of years, but like I said earlier in this discussion, the quality projects are being financed and they're starting to bifurcate. So if you get into the right stocks at around this time over the past 6 months to a year, and you've been accumulating these positions in the right companies, you're going to do very well in the next couple of years, because we all know that this sector is about to flip. We just don't know when it's going to happen.
You are listening to MSE. I'm Bill Powers, your host. Thanks for tuning in. Chatting today with my friend David Erfle from JuniorMinerJunkie.com. David, welcome back onto the show. And many people are talking about whether we are or are not at a cyclical bottom here in the junior gold stocks. You've seen multiple bottoms in the gold stocks. If this is a bottom, how does it differ than previous bottoms that you've discerned in retrospect?
Yeah. We were talking about this right before you press record, and thanks again for having me on. Always great to talk to you. I always look forward to these chats. It's, I've been here a few times to where we're all at right now. Anybody who's listening, they're probably, feeling the same way we are as far as the juniors are concerned. But the last two times I was at the market was in a sentiment situation as it is right now. And, it was the gold price was threatening to break down. That, along with the gold stocks that had already broken down. Now it's complete opposite. We have a gold price that's already broken out intraday. It hasn't broken out technically into a new bull market yet, but it's threatening to break out, and yet the juniors continue to sell off. And, we've talked about the reasons why for this in the past, so I won't go into it. But as far as a comparison is concerned, it is a lot like late 2015, early 2016. But back then, not very many projects were getting financed. The money window was tight for everyone, but not this time. I mean, now the really good projects that are run by really good people in really good jurisdictions, and they have blue sky potential, and they're getting financed. Granted, the money is more expensive now because we're not in a zero interest rate environment anymore. The discount rate they should be using on the capex to build these mines should be an 8% discount rate, not 5%. I don't know why they continue to use 5%, but that's another story. But anyway, I mean, as far as the sentiment is concerned, I mean, we've reached maximum pessimism. We've reached it. You could tell that in a lot of these juniors that continue to bifurcate higher, and the ones that are going lower, the street knows they need money, because let's face it, the street is controlling a lot of these stocks right now because there's no retail interest out there to take up the slack, right? So basically, there's I hate to say this, but there's no dumb money out there to take up the slack. So if the street sees, okay, look, wow, this company's released their work program for 2024, they're going to need money. We're going to continue to sit on their stock, right, until they announce a finance, and then we're going to be able to get into that finance really cheap, probably get a warrant, half warrant, full warrant. So we're just going to wait, and we're going to keep pressure on the stock. And they can continue to do that until this sector turns, until that switch flips, right? And we know what that switch flip looks like because it's happened in the past. I mean, I've experienced it a few times, so I know exactly what to look for, and I know exactly the type of companies to invest in while waiting. I mean, that's the thing, right? I mean, you got to be into the right companies right now while you're waiting for that switch to flip.
When you're an executive of one of these juniors, you've got to communicate to the markets, so there has to be some sort of IR budget. But one of the things we're seeing is that, especially with early stage companies, like there's no amount of promotion that's going to move a stock, right? There's no liquidity.
You're
there's no
money. Yeah. If you're an early stage company right now and you're promoting, you're spending money on promotion, it's pretty much wasted promotion unless you've already made a major discovery and you're promoting that discovery, and the market is giving you love for that discovery, then yes. But you're still seeing a lot of these small raises. I just saw a few of them last week. These small $1-2 million raises. That's keep the lights on money. It takes it takes between $1 to $2 million to keep the lights on in juniors right now. So, you got to stay away from companies like that. Stay away from companies that need money, and then when they finally do raise money, it's not even going to cover a 5,000 meter drill program. I mean, that's hope and dreams companies are the ones to stay away from right now. Well, they have been for the past few years, and I have been staying away from them.
When you say that the good projects can still get financed, it seems to me, though, like more of the novel projects that maybe haven't been known for years, but maybe have a more recent discovery. Don't you see capital flowing to those a little more than some of what you and I might say is a good project, but it's been known for longer, so its luster has come off for new dollars?
Absolutely. And yes, there are a few discovery plays that have really done well. Look at Snowline. Snowline, there's no infrastructure there, and it's over $1,000 a meter to drill, and yet that stock continues to go higher, and the market cap goes closer and closer to $1 billion. So there is a few of these companies that are getting a lot of love from the market, but as a whole, they're not. You're taking a big risk if you're investing in these early stage companies right now. Why bother when you can invest in these quality juniors that have got something, and they've done a great job de-risking this thing. They've raised money at the right times. They've kept their share structure generally tight. They're in a good jurisdiction. They've got blue sky potential on their property. The street hasn't been able to force their stocks down lower because they have the access to capital. They've got a fully funded budget for 2024. They've got a lot of ounces in the ground. They got high margin projects. I mean, that's why this is a great market right now. Let's face it. I mean, it is a great market for speculation. But, you just have to pay attention and invest in the right companies. I can't stress that enough, because if you're going to bottom fish and you're going to try to build a portfolio here at the bottom, and that's what you should be doing if you're in the sector, and don't put any more than 5% of your capital in any one company. I mean, that's one of my rules. I just never do that. I don't care how great a junior looks. I look at a junior, I say, wow, this ticks every single box, which is rare. I'm going to load up on this thing. I just learned in the past, you don't do that. You have to collect a basket, and you have to, and you can't overweight into one. And there are going to be several of them that are going to go bad on you. It's going to happen. I mean, most of the stocks you invest in this sector are going to lose money. You have to know that before getting into it. But the ones that you get right, all it takes is just a few of them for you to get right, and you'll do really, really well, and you'll more than cover your losses, and you'll make a very good living in the sector. I mean, I've said this in the past, that this is the most challenging, most difficult market to make an easy living in if you know what you're doing.
Dave, when you see a spike down, there's a junior that you have your eye on, it's on your watch list in this market, and you like the management, they got some money, they got a good project. You see a spike down, which you and I know could just be one guy selling. He's got $200,000 worth of share. He needed to exit for some reason.
Oh, there's fund redemptions going on like crazy right now. You see a big volume spike in a stock and a fishing line. Call up management and say, hey, look, what happened? There was no news. What happened? Well, this fund is getting out, or this whale decided to shift his capital elsewhere. I mean, that's usually what it is. And that's a buying opportunity.
And would you buy, like if it's on your watch list, you've already screened it, do you usually pull the trigger when
I've done it several times in the past. Yes. I mean, I've had things on my watch list for years before I get into them. I mean, Novo Resources way back, in 2017 was one of those. I watched it for years. I'd kept in contact with Quentin, and every time I saw him at a conference, how close are you to doing what you planned and getting close to what you think is happening there. And I got lucky, but I put myself in the position to get lucky. That's what you need to do. You need to watch these things for a long time, get familiar with the company, get familiar with the chart, get familiar with how it trades, keep in contact with management. That's why I go to these conferences. I don't go to all of them. I just narrowed it down to 2 now. They're every 6 months. I go to Beaver Creek and I go to PDAC, because all the companies and all the people I want to talk to go to both. So, you have to keep your head in the game. You have to, and this is a great time to do all this research because let's face it, nobody wants juniors right now. And, when you're a contrarian investor, and you have to be a contrarian investor in this sector, that's the best time to buy, because the most money you're going to make is the investment you make in a market just like this.
You have a lot of small cap investors teach that illiquidity is your friend when you buy the stock, because you want to get in before the liquidity is there. Okay.
Right. The more it hurts when you press that buy button, the better it is.
Okay. Now, that may be true, and I've experienced that myself. However, we have to admit that for you and I, in these juniors, it's becoming more illiquid to where the ETFs are not going down the food chain. U.S. money, even my and your money, it's harder for us to even buy in brokerage account. If the stock's under $1 in a lot of accounts, you can't even buy it. So that does bother me a little with some of the big positions I have. Any more thoughts you have on this, Dave?
Yeah, I mean, it happened Monday last week, right? Right out of the blue. The SILJ was part of this this benchmark switch where this new company, Amplify Prime Junior Silver Miners, it's not VanEck anymore, the SILJ. It's now Amplify Prime Junior Silver Miners, and they switched their benchmark. So they put a surprise on the market and basically said, look, we're reweighting or adding or deleting 74 different juniors. BMO put out a release where they sussed that it was 74 companies. I think it was probably based on the volume, because you saw these huge volume spikes in a lot of these silver and copper related juniors. And basically what is happening is in these ETFs, these so-called junior ETFs, right? They're becoming a lot less junior because of liquidity issues. So, when I came into this sector back in 2003, there was no GDXJ, there was no SILJ, there was no GDX either. So these stocks can move without the benefit of being in these ETFs. So, but what's happening is they're taking out these smaller cap juniors, making them less junior. They're becoming basically mid-tier ETFs, and they're even putting large cap royalty streaming companies in them, along with mid-tiers and some majors, to get the liquidity. So even though they call themselves junior indexes, they're not really junior indexes. So, you need to do what I've been doing, for the past 20 years, is basically create my own fund, create my own basket of companies that I think are the best, and manage it yourself. Because you can't really use these ETFs as a barometer anymore for the sector. You can't look at the GDXJ and go, wow, look, GDXJ is down today. It's going down a lot more because the junior sector sucks. I mean, yeah, sure, an argument can be made that the junior sector has sucked over the last couple of years. But like I said earlier in this discussion, the quality projects are being financed, and they're starting to bifurcate. So if you get into the right stocks at around this time over the past 6 months to a year, and you've been accumulating these positions in the right companies, you're going to do very well in the next couple of years, because we all know that this sector is about to flip. We just don't know when it's going to happen. But 2008 and late 2015, early 2016, those were both election years. The gold price has been doing well in 2016 and also 2020. You also had the gold price starting to go up along with the juniors and the majors and the minors, because it was an election year, and the Fed started to lower rates. So we know the Fed's going to lower rates. We just don't know when. They keep jawboning, and saying, it may not be March, now it's going to be May, yada, yada, yada. But we know it's going to be, we know it's coming soon. And every time the Fed has to lower rates, gold stocks go up, gold goes up, and if you take a look at silver price and gold stocks, they basically trade in tandem. So when they're showing relative weakness to the gold price, there's going to be some more consolidation going on in the sector. And that's what's been happening ever since the end of last year, right? Silver and the miners started to show relative weakness and lead gold lower. So when they start to turn, when you start to see the gold miners and and we start to see gold stocks and silver start to show relative strength to the gold price, you know it's about to turn. I mean, you just take a look at the silver price over the past 4 years. Look at a silver chart and look at a GDXJ chart. They're almost exactly the same, and they're both forming this huge consolidation triangle, right, from the COVID spike low from the mid-August 2020 high. They've been making lower highs and higher lows, and they're coming down into this triangle. And I would say within the next 2-3 months, you're going to have a resolution, either a breakout or a breakdown. And it sure feels like to me it's going to be a breakout, because there's not a lot of people left to sell as far as the breakdown is concerned. But what you might see is a false move first. That's usually what you see in this sector, is you see a false move before you see a breakout in the opposite direction. So especially in commodities, whenever something is about to break out, especially when it's been consolidating for a long time, you usually get a false move lower first. That creates the energy for the breakout, right? Because something's not going to break out when it's too overbought and everybody's expecting it. It happens when there's a false move lower first. It gets all the weak hands out, and that creates the energy for the bounce, right? It happened at 1650 gold, right? Everybody was looking at 1675 gold. Everybody was looking at 1675. Wow, and that breaks, the gold's going to go down to 1500, 1450, whatever, right? Well, it broke, and it was a false move. It was a bear trap. And what did it do? It reversed, and the gold price went up almost $500 in a few months. So this is what typically happens in this sector. It happened in early 2016. Everybody was expecting the bottom to hold that was building in late 2015. We had a false move lower. It got everybody out of position. It basically ran the stops of a lot of these speculators that were building positions, thinking this is it. It's going to go higher. Well, it got them all out of position. It reversed on the very same day that it broke down. And then it didn't even look back. It went up like 250% in 6 months. And all those people that got stopped out were afraid to chase it, right? I mean, they'd lost money while they were building a bottom. Like, I'm not going to chase. I'm going to wait for it to come back down. And it never did. So that's what this sector does. It basically tries to fake you out and shake you out as much as it can before it breaks out.
The fake out before the breakout.
Fake out before the breakout, right?
And you had 350 grand, I believe, deployed at the time, and you turned that into $1 million in about 6 months, right? That's a correct story?
I mean, absolutely, yes. I mean, this is how it works in this sector. I've been doing this, since I did something crazy and sold my house and put all the proceeds into juniors back in 2005. I did all this research for 2 years, and I had a really good feeling after all the research I did. And technically, this thing was about to break out. And let's face it, I got lucky, but I put myself in the position to be lucky. I put all that money into juniors. And back at that time, I really didn't know what I was doing. But back in 2005, you didn't have to know what you were doing. Everything went up. And in a couple of years, I became financially independent, and I never had to, work for anybody else again. So, I mean, that's what this sector could do for you. I'm definitely not suggesting that anybody goes out and do that. I mean, I was at the time, I didn't have a family. It was just me. So I was just risking my financial future, not the financial future of my family. But ever since then, I've had the exact same amount of money invested in juniors, either on the long side or the short side. During the bear market of 2013 down to 2015, I made money on the short side. But $475,000 is what I had invested back when I sold my house. That's what I made on my house. That's what I put in juniors. And now I continue to have that much money invested. But I always take out my realized capital gains. I don't reinvest them.
Do you know that number off the top of your head in the last 15 years? Like what did you realize?
Ever since the bottom in late 2015, early 2016, when I started my junior portfolio again back in late 2015, early 2016 with 475. I've taken out realized capital gains of $625,000 coming into this year. So I've averaged annual return of 18%. on my junior portfolio during a bear market. Because let's face it, ever since gold bottomed at $1,000, the juniors have still been in a bear market. They've been in a bear market for the past 11 years. And the reason why they've been in a bear market for the past 11 years, even though the gold price has gone up to $2,000, is because you don't have general investor interest in this sector.
All right, let's point this out though for the newbies. So you made 18% year over year. However, you had 10 baggers in there, such as what you already mentioned.
Oh, yes.
With Quinton Henning, and you had some others. I know you had a number of 4 baggers. So it's those 4 and 5 baggers, and then a couple of those 10 baggers where you really cleaned up. And then a number of losses like we all do, right? So it's
exactly. You're gonna lose. I'll tell you this right now. If you're thinking about getting into this sector, you're gonna lose more money. You're gonna lose money more times than you're gonna make money on the juniors you invest in. You have to look at it like basically you're a baseball player and you want to get in the Hall of Fame, right? And you have to hit over 300. You have to hit over 300 to get in the Hall of Fame if you're a baseball player, right? So that means they're getting a hit 3 out of every 10 times.
I say 400 though, Dave. Ted Williams was at 400.
So if you have winners in 3 out of 10, big winners in 3 out of 10, you're going to do well. You just have to know when to cut your losses and know when to ride the gains. And also you have to know the hardest part.
Know when to hold them, know when to fold them, right? As the song says.
I mean, any fool could buy a stock, when it's tanking like right now, right? I mean, anybody can be accumulating right now, and anybody can do that. But the difficult part is knowing when to sell. I've got so many stories of so many stocks that I sold too early, and so many stories of so many stocks that I sold too late.
So mining stocks wear you out or scare you out. Is the only reason you would be scared out of a stock, so to speak, is if there's something fundamental you don't like that occurs in that stock?
Absolutely. Yeah,
that would be the reason.
They screwed up something that was monumental, something that's going to blow up their share structure. That's a big one. If they waited too long to raise money, and this recently happened to me. I was expecting this company to raise money. They didn't do it at the window that they should have. They waited too long. And when I realized that they're going to have to raise money at a lower price, then the street realizes it too, their stock is going to tank. And that's what happened. So you have to get out. You have to be looking at what the street's looking at in these stocks, and as far as finances are concerned, because, that window hasn't opened yet where everything gets financed, and you'll know when it happens, right? You knew when it happened in early 2016 when everything started to get financed. And to tell you the truth, I hope it doesn't happen. I don't want to see everything get financed, because a lot of these companies need to go away. It needs to consolidate. There's too many lifestyle juniors. There's like 80 to 85% of these things. You've heard Rick Rule say it 1,000 times, and he's right. There's just too many lifestyle companies out there that were getting financed. Well, now they're on the ropes, and it's easy to tell which ones are on the ropes. So it's easy to tell right now which ones to stay away from. And if you need assistance in picking the right ones, you can subscribe to a newsletter like mine.
And Dave's website is juniorminerjunkie.com. He's been at this a while. If you're new to learning about Dave, you can get on his free email list. He'll send you out a weekly commentary, usually about the macro situation, the Fed, the gold price, and some light commentary on the juniors. But if you want more detailed guidance, he does have a paid-for subscription. Again, you can find that at his website. Dave, always great chatting, and we'll do it again in about 30 days on the show.
Look forward to it, Bill. Thanks a lot.